Why smart retirees are converting everything to Roth. If you're over 60 and have a sizable nest egg, pay close attention. The IRS is quietly set to collect tens, sometimes hundreds of thousands in taxes from traditional retirement accounts. But here's what most retirees overlook. Converting to a Roth IRA at the right time could save you $50,000 or more over your lifetime. The longer you wait, the more you risk losing to taxes that could have been avoided. Many seniors I've worked with after decades of saving are shocked to learn how much of their money could be lost to future tax hikes, required minimum distributions, and even taxes on Social Security. In my 30-plus years guiding affluent retirees through these decisions, I've seen one pattern. The most successful, stress-free retirees typically take action before it's too late. This is educational content designed to help you make informed financial decisions. Always consult with a qualified financial advisor for your specific situation. And remember, past performance doesn't guarantee future results. Today, I'm going to show you exactly why the wealthiest, most prepared retirees are moving their assets to Roths, and how you can do it too. By the end of this video, you'll know the key steps to potentially save thousands in taxes, protect your legacy, and gain control over your retirement income. But first, let me share the critical mistake that costs retirees more than any market downturn, because what you're about to hear could change your entire outlook on retirement. Part 1. The hidden tax trap lurking in your retirement accounts. Let's start with a reality check that most retirees simply aren't prepared for. You've spent decades building your nest egg, diligently saving in your 401k, IRA, or maybe even a few brokerage accounts. You've made sacrifices, skipped luxuries, and done everything the financial experts said you should. Now, as you approach or move through your 60s, you're looking forward to finally enjoying the fruits of your labor. But there's a problem most people never see coming. A problem that could quietly drain away tens or even hundreds of thousands of dollars from your hard-earned savings. In my 30-plus years of helping affluent American seniors prepare for retirement, I've seen this scenario play out again and again. Retirees who believe they're set for life, only to be blindsided by a tax bill that feels like a punch to the gut. Here's the cold, hard truth. If your savings are mostly in traditional tax-deferred accounts, like a 401k or a traditional IRA, you are carrying a massive, often invisible tax liability. The money in those accounts isn't all yours. A significant portion, sometimes as much as 30% or more, belongs to the IRS. And the longer you wait to address it, the more you stand to lose. Let me repeat that important point. Every dollar you withdraw from a traditional retirement account is taxed as ordinary income. If you're like most seniors I've worked with, you could be looking at tax rates between 22% and 32% in retirement, depending on your income and where tax laws go in the future. That means if you have a $1 million IRA, you might only be able to spend $700,000 of it or less after taxes. The rest goes straight to the government, and that's before considering state taxes, potential Medicare surcharges, and the impact on your Social Security benefits. Now let's look at some numbers that should give you pause. According to Fidelity's 2023 Retirement Savings Assessment, the average retiree with a 401k or IRA has approximately $240,000 saved by age 65. But for higher income households, like many of you watching, it's not uncommon to see balances between $500,000 and $100,000, $1.5 million. On paper, that looks like plenty. But when you factor in required minimum distributions, or RMDs, starting at age 73, you could be forced to withdraw and pay taxes on tens of thousands of dollars each year, whether you need the income or not. Let's say you have $1 million in a traditional IRA at age 73. The IRS will require you to withdraw about $36,500 in your first year, based on the current RMD tables. That $36,500 is added to your taxable income for the year, possibly pushing you into a higher tax bracket. and RMDs only increase as you age. By age 80, your required withdrawal could be over $50,000 per year. Over a 20-year retirement, you could end up paying $200,000, $300,000, or even more in taxes, money that could have gone to your family or enjoyed in your golden years. And here's where it gets even more concerning. Tax rates today are near historic lows. The federal government's debt has surpassed $34 trillion, and many experts, including those of us who have been in this business for decades, believe taxes are likely to rise in the future. If Congress raises tax rates to deal with the national debt, retirees with large pre-tax balances will be hit the hardest. You could see your effective tax rate jump by 5%, 10%, or more, costing you tens of thousands of dollars in additional taxes over your retirement. But the pain doesn't stop there. The tax trap in traditional accounts can also trigger higher Medicare premiums. Many retirees don't realize that if your income crosses certain thresholds, $103,000 for individuals or $206,000 for couples in 2024, your Medicare Part B and D premiums can jump by hundreds of dollars per month. It's called IRMAA, the Income-Related Monthly Adjustment Amount. I've seen retirees pay an extra $3,000 or more per year in Medicare premiums simply because their RMDs push them over the limit. That's money right out of your pocket every single year. And don't forget about Social Security. Up to 85% of your Social Security benefits can be taxed if your combined income exceeds just $44,000 for a married couple. RMDs from your IRA or 401k are counted as income, which means you could end up paying taxes on money that was supposed to be tax-advantaged in retirement. Let me share a quick story from my own experience. I worked with a couple in their early 70s who had saved diligently, over $1.2 million in their 401ks and IRAs. They thought they were in great shape. But once RMDs kicked in, their taxable income soared, their Medicare premiums doubled, and they ended up owing an extra $12,000 in federal taxes every year, money they never planned for. Over a 20-year retirement, that's nearly $250,000 lost to taxes and surcharges alone. And sadly, their story is all too common. Now, you might be thinking, but I was told to defer taxes as long as possible. Isn't that the smart move? For decades, that was the conventional wisdom, but the landscape has changed. With rising account balances, longer life expectancies, and the very real threat of higher future tax rates, deferring taxes can backfire, especially for affluent retirees like you. And here's another sobering fact. When you pass away, your heirs may have to drain your IRA or 401k within 10 years, thanks to the Secure Act. If they're in their peak earning years, they could pay 32% or more in taxes on your legacy. That means a $500,000 inheritance could shrink to $340,000 after taxes, leaving your children or grandchildren with far less than you intended. In my 3 decades of guiding retirees through these complex decisions, I've seen too many people blindsided by these hidden tax traps. The most successful retirees I've worked with are the ones who recognized these risks early and took action before it was too late. So let's recap what we've covered so far. If you have substantial savings in traditional retirement accounts, you face a triple threat: income taxes that erode your nest egg, higher Medicare premiums that eat into your cash flow, and the risk of leaving your heirs with a hefty tax bill. And with the possibility of rising tax rates on the horizon, the urgency to act has never been greater. This is educational content, not personalized financial advice. For your unique situation, always consult with a qualified financial advisor who understands the latest tax laws and retirement strategies. I want you to be empowered with knowledge, not pressured by fear. But I also want you to understand the stakes, because every year you wait, the window to make a smart move gets smaller. But here's what most financial advisors won't tell you. There is a proven conservative strategy that can help you sidestep this tax trap, protect your income, and maximize the legacy you leave behind. It's a strategy the wealthiest and most financially savvy retirees are quietly using right now, often saving $50,000, $100,000, or more in lifetime taxes. What is it? And why is it so effective for people just like you? The solution is simpler than you think, but most people get it wrong. Part 2. The Roth Conversion Advantage, a safety net for your retirement and legacy. Let's build directly on what we just discussed, those hidden tax traps inside traditional retirement accounts. The good news is that you're not powerless. There is a well-established, conservative strategy that thousands of affluent retirees across America are quietly leveraging to protect their savings from future tax hikes, reduce their Medicare premiums, and leave a larger legacy for their families. It's called a Roth conversion, and for many people in their 60s and early 70s, it's the single most effective move you can make to secure your financial future. Now, before we dive into the details, let me make something very clear. This is educational content, not personalized financial advice. You should always consult with a qualified financial advisor for your unique situation. Every retiree's financial picture is different, and the right strategy for you depends on your income, your tax bracket, your health, your goals, and your legacy plans. But after more than 30 years of working with retirees just like you, people who have saved diligently and want to protect what they've built, I can tell you that Roth conversions have become a cornerstone of modern retirement planning. So, what exactly is a Roth conversion? Simply put, it's the process of moving money from a traditional tax-deferred retirement account like a 401k or a traditional IRA into a Roth IRA. When you do this, you pay income tax on the amount you convert in the year of the conversion. But here's the key. Once your money is in a Roth IRA, it grows tax-free, and qualified withdrawals are never taxed again. There are no required minimum distributions, RMDs, for Roth IRAs during your lifetime, which means you have total control over when and how you use your money. And perhaps most importantly, your heirs can inherit your Roth IRA and enjoy tax-free withdrawals, giving your legacy a powerful boost. Why does this strategy work so well for seniors, especially those with substantial retirement savings? First, let's talk about tax diversification. If all your assets are in pre-tax accounts, you're at the mercy of future tax rates. By converting a portion of your savings to a Roth, you're creating a pool of tax-free money you can tap in retirement, no matter what Congress does with tax laws down the road. In my experience, the most successful retirees are those who have both taxable and tax-free sources of income. This flexibility can save you tens of thousands of dollars over your retirement. Second, Roth conversions can help you manage your taxable income and avoid costly Medicare surcharges. Remember those IRMAA thresholds we talked about? If you can fill up lower tax brackets with Roth conversions in your 60s before RMDs kick in, you may be able to keep your future income below the levels that trigger higher Medicare premiums. I've seen retirees save $3,000 to $6,000 per year on Medicare costs simply by planning their conversions carefully. Let me share a brief story to illustrate this. A few years ago, I worked with a couple from Ohio, both in their early 60s, who had just retired with about $1.1 million in their 401k and IRA accounts. They were worried about future taxes and wanted to leave as much as possible to their 2 daughters. We ran the numbers and decided to convert $80,000 per year from their traditional IRAs to Roth IRAs for 5 years, staying within the 22% tax bracket. Yes, they paid about $18,000 in taxes each year on those conversions. But by the time they reached age 73, their RMDs were cut in half, their Medicare premiums stayed low, and their Roth IRAs had grown to nearly $500,000, all tax-free. When they eventually pass those accounts to their daughters, every dollar will be inherited tax-free. That's a real, measurable impact, over $150,000 in tax savings for their family, just by taking action in their 60s. Here's another example. I recently met with a widowed client in Florida, age 68, with $900,000 in her IRA and about $100,000 in a taxable brokerage account. She was concerned about RMDs and didn't want to see her Social Security taxed at the highest rate. We mapped out a series of Roth conversions over 7 years, each one carefully sized to avoid jumping into a higher tax bracket. By the time she reached her early 70s, nearly half her retirement savings were in Roth IRAs, and her required withdrawals were manageable. She gained peace of mind knowing that her income in retirement would be stable, her health care costs predictable, and her legacy protected from unnecessary taxes. What makes Roth conversions especially powerful for retirees in your age group is the unique window of opportunity you have after you retire, but before you're forced to take RMDs at age 73. During this period, your taxable income may be lower than it was during your peak earning years, which means you can convert larger amounts at lower tax rates. This is a strategy that industry insiders and the wealthiest retirees have been using for years, but it's available to anyone who plans ahead. Now you might wonder, isn't it painful to pay all those taxes up front? It's a fair concern, and one I hear from almost every retiree. But here's what you need to remember. You're choosing to pay taxes now at known rates, rather than gambling on what future tax rates might be. Historically, tax rates are near 40-year lows. If you believe, as many experts do, that rates are likely to rise in the coming decade, converting now can be a form of tax insurance. The most conservative retirees I advise often convert just enough each year to fill up their current tax bracket, minimizing the pain while maximizing long-term benefits. And the benefits go beyond just tax savings. With a Roth IRA, you don't have to worry about RMDs disrupting your cash flow or forcing you to sell investments at the wrong time. You control when and how you access your money. This flexibility is invaluable, especially if you have unexpected healthcare costs, want to help your grandchildren with college, or simply want to enjoy your retirement without worrying about the IRS taking a bigger slice each year. Let's recap the foundation we've laid. Roth conversions are not a get-rich-quick scheme. They're a safety-first proven strategy with a 40-plus year track record of helping retirees keep more of what they've earned. By converting at the right time, in the right amounts, you can reduce your lifetime tax bill, avoid costly Medicare surcharges, and leave a larger tax-free legacy for your loved ones. In my decades of experience, I've seen the happiest, most financially secure retirees are those who took control of their tax situation early, rather than waiting until the IRS forced their hand. But as with any powerful financial tool, the details matter. The process of converting to a Roth IRA is simple in concept, but there are critical steps you need to follow to avoid unnecessary taxes, penalties, or missed opportunities. Many retirees make the mistake of converting too much, too fast, or too little, too late. That's why it's essential to have a clear step-by-step plan tailored to your unique situation. Now, let me show you exactly how to implement this strategy in your own retirement plan. I'll walk you through the specific steps you need to take, the numbers you need to know, and the common pitfalls to avoid. Because the solution is simpler than you think, but most people get it wrong. Part 3. Your step-by-step guide to a smart Roth conversion. Now that you understand why Roth conversions can be such a powerful tool for affluent retirees, let's get practical. I want to walk you through the exact steps I've guided hundreds of clients through over the past 30-plus years, so you can approach this with confidence, clarity, and the peace of mind that comes from having a solid plan. This is educational content, not personalized financial advice, so remember to consult with a qualified financial advisor who knows your specific situation before making any decisions. But by following these proven steps, you'll be able to make informed choices and avoid the most common missteps. Let's take this one step at a time, at a pace that feels comfortable and never rushed. The most successful retirees I work with are those who take a methodical, thoughtful approach. Never rushing, never gambling, always protecting their principal and staying focused on the long-term benefits. Step 1. Calculate your current and projected tax brackets. The very first thing you need to do is determine your current tax bracket and estimate what your tax bracket might be in the coming years, especially once required minimum distributions, RMDs, begin at age 73. For 2024, the 22% federal tax bracket for married couples filing jointly goes up to $206,700, and the 24% bracket tops out at $240,000, $383,900. For single filers, those numbers are $100,525 and $191,950, respectively. Why does this matter? Because the goal with Roth conversions is to fill up your current bracket without accidentally bumping yourself into a higher one, which could mean paying thousands more in taxes than necessary. Let me give you an example. Suppose you're a married couple, age 65, with $120,000 in taxable income from pensions, Social Security, and investment income. You're in the 22% bracket. You could convert up to $81,050 from your traditional IRA to a Roth IRA this year and stay within that 22% bracket. If you converted more than that, you'd start paying 24% on the excess. This is why precise calculations, down to the dollar, are so important. Step 2. Decide how much to convert. Each year, once you know your bracket, the next step is to decide how much to convert each year. The most conservative, safety-first approach I recommend is to convert just enough to fill up your current bracket, as we discussed. For some, that might mean converting $20,000 to $40,000 per year. For others, it might be $60,000 or more, depending on your income and other sources of cash flow. Many retirees find that a multi-year approach, converting a portion each year over 5 to 7 years, is the most tax-efficient and least disruptive to their lifestyle. For example, if you have a $700,000 IRA and want to minimize future RMDs, you might convert $50,000 per year for 10 years. That's $500,000 moved to tax-free status, potentially saving you $100,000 or more in future taxes, depending on how tax laws evolve. Here's a real-world scenario. I worked with a couple in their early 60s who converted $35,000 per year for 8 years. They paid about $7,700 in federal taxes each year on the conversions, money they planned for and paid out of a separate savings account, not from the IRA itself. By the time they reached their early 70s, their RMDs were cut nearly in half, and their Roth IRA had grown to $400,000, all tax-free. That's a conservative, step-by-step method that protects principal and avoids surprises. Step 3. Time your conversions. Strategically. Timing is everything with Roth conversions. The optimal window for most retirees is after you stop working and before RMDs start, typically between ages 60 and 73. During this period, your income may be lower, giving you more room in those lower tax brackets. Every year you wait, your IRA or 401k balance continues to grow, which can push you into higher brackets once RMDs begin. Acting early gives you more control and flexibility. If you're already receiving Social Security or pension income, coordinate your conversions to avoid pushing yourself into higher tax brackets or triggering Medicare IRMA surcharges. For 2024, the IRMA threshold for Medicare Part B surcharges is $206,000 for couples and $103,000 for individuals. If your modified adjusted gross income, MAGI, goes above these limits, your monthly Medicare premiums could jump by $70 to $400 per person. I've seen retirees lose $3,000 or more per year in unnecessary Medicare costs simply because they didn't plan their conversions carefully. A smart approach is to schedule conversions for the end of the year when you have a better idea of your total income. This gives you the flexibility to adjust the conversion amount and stay within your target bracket. Step 4. Pay taxes the right way. When you convert funds from a traditional IRA to a Roth IRA, you'll owe income tax on the amount converted. The key to maximizing your long-term benefit is to pay those taxes from a separate, non-retirement account, such as a savings or brokerage account, rather than from the converted funds themselves. This ensures that every dollar you convert gets the full benefit of tax-free growth in your Roth IRA. For example, if you convert $40,000 and your combined federal and state tax rate is 22%, you'll owe $8,800 in taxes. If you pay those taxes out of your IRA, you're reducing the amount that can grow tax-free. But if you pay from a separate account, the full $40,000 gets to work for you in the Roth, compounding tax-free for years to come. In my experience, the most successful retirees plan for this tax bill each year, setting aside funds in advance so there are no surprises come tax time. Step 5. Coordinate with Social Security and other income sources. This is where things get a bit more nuanced, but it's absolutely critical. If you're not yet taking Social Security, consider delaying your benefits while you complete your Roth conversions. Delaying Social Security not only increases your monthly benefit by up to 8% per year between full retirement age and age 70, but it also keeps your taxable income lower, giving you more room for conversions at lower rates. If you're already receiving Social Security or other income, work with your advisor to model how conversions will impact your taxable income, Medicare premiums, and potential taxation of your Social Security benefits. I've seen retirees lose out on thousands of dollars in benefits simply because they didn't coordinate these moving parts. Let me repeat this important point. The order and timing of your income sources can make a huge difference in your long-term tax bill. The most successful retirees I've guided always take a holistic view, looking at all sources of income and how they interact with their conversion strategy. Addressing common concerns. Now, I know many of you are concerned about making a mistake or triggering an unexpected tax bill. That's why it's so important to work with a qualified financial advisor and a tax professional. They can run precise projections, taking into account your unique situation, state taxes, and any special circumstances like charitable giving or large medical expenses. And remember, this is educational content, not personalized financial advice. Let's quickly recap what we've covered so far. You now have a clear step-by-step framework for executing a Roth conversion. Calculate your tax bracket, decide how much to convert, time your conversions strategically, pay taxes from a separate account, and coordinate with your other income sources. These are the exact steps I've seen deliver the best results for retirees seeking security and peace of mind. But before you take action, you need to avoid these critical mistakes that can cost you thousands or even tens of thousands of dollars. Because even a small misstep can derail your plan and leave you worse off than before. Before you do anything, avoid this costly mistake. Part 4. The expensive Roth conversion mistakes that can derail your retirement. Now that you have a step-by-step game plan for a Roth conversion, it's time for a reality check. In my 30-plus years helping retirees navigate these decisions, I've seen even the most diligent, well-intentioned people stumble into costly traps, sometimes losing tens of thousands of dollars in unnecessary taxes, penalties, or lost benefits. The good news is that with awareness and a conservative approach, you can sidestep these pitfalls. But you need to know exactly what to watch for, because even a small oversight can turn a smart strategy into an expensive regret. This is educational content, not personalized financial advice. Please consult a qualified financial advisor before making any moves, especially since the IRS rarely gives second chances on these mistakes. Let's walk through the most common and expensive Roth conversion blunders I've seen, along with the warning signs that signal trouble ahead. Mistake number 1, accidentally pushing yourself into a higher tax bracket. This is by far the most common error. Many retirees, eager to get it over with, convert too much of their IRA or 401k in a single year. The result? They unintentionally push themselves into a higher federal tax bracket, sometimes paying 24% or even 32% on part of their conversion instead of the 12% or 22% they expected. For a $60,000 conversion, that can mean an extra $6,000 to $12,000 in federal taxes, money that could have stayed in your pocket. Let me share a quick story. I once worked with a couple who converted $150,000 in 1 year, thinking they'd rip off the Band-Aid. When tax time came, they realized their federal tax bill had jumped by nearly $20,000, plus another $3,000 in state taxes. The shock was real. The warning sign here is simple. If your total income, including the conversion, approaches the next tax bracket threshold, pause and run the numbers with your advisor. Remember, the tax brackets for 2024 are $201,050 for married couples and $100,525 for singles at the top of the 22% bracket. Going even $1 over pushes your next dollar into the 24% bracket. Mistake number 2, triggering unnecessary Medicare. IRMA surcharges. Many retirees don't realize that Roth conversions increase your modified adjusted gross income, MAGI, which is what Medicare uses to determine your Part B and Part D premiums. If your MAGI crosses $103,000, single, or $206,000, married, in 2024, you'll face IRMA surcharges that can add $70 to $400 per month per person to your premiums. That's $840 to $4,800 per year, sometimes more if you cross multiple thresholds. I've seen retirees lose $3,000 to $6,000 in a single year because they didn't account for this. The warning sign: if your income is already close to the IRMA threshold, any significant Roth conversion could trigger these surcharges for the following year. Medicare looks at your tax return from 2 years prior, so a big conversion in 2024 could increase your premiums in 2026. Always project your MAGI before converting, and consider spreading conversions over several years to stay below the thresholds. Mistake number 3, paying taxes from the IRA instead of a separate account. This is a subtle but expensive mistake. Some retirees use funds from the IRA being converted to pay the tax bill, rather than using cash from a separate savings or brokerage account. The result? You reduce the amount that goes into the Roth, which limits your long-term tax-free growth. For example, if you convert $50,000 but use $10,000 from the IRA to pay taxes, only $40,000 makes it into the Roth. Over 20 years, that missing $10,000 could have grown to $32,000 or more, assuming a 6% annual return. That's a $22,000 opportunity cost, just from paying taxes the wrong way. The warning sign here is if you don't have enough cash on hand to pay the tax bill, or if your advisor suggests withholding taxes from the conversion. In my experience, the wealthiest and most successful retirees always plan ahead and use outside funds for taxes, maximizing their tax-free compounding. Mistake number 4, ignoring the impact on Social Security taxation. Here's a trap that catches many by surprise. Roth conversions count as ordinary income, which means they can push your combined income above the thresholds that trigger taxation of your Social Security benefits. If your combined income exceeds $44,000 as a married couple or $34,000 as a single filer, up to 85% of your Social Security benefits become taxable. For some retirees, this can mean an extra $2,000 to $4,000 in taxes per year, unexpected and unwelcome. I've seen retirees inadvertently double their Social Security tax bill because they didn't coordinate their conversion with their benefit timing. The warning sign: if you're already receiving Social Security and considering a sizable Roth conversion, model the impact on your combined income first. Sometimes it's worth waiting a year or staggering the conversion over multiple years to avoid unnecessary taxes. Mistake number 5. Converting too late, missing the optimal window. Timing is everything. Some retirees wait until after RMDs begin at age 73 to start converting, only to find their required withdrawals push them into higher tax brackets, making conversions far more expensive. Others wait until they're in their late 70s or 80s when health issues or legacy concerns make planning more complicated. The cost of waiting? You could end up paying 5% to 10% more in taxes on every dollar you convert, or worse, missing the chance to convert altogether. The warning sign here is procrastination. If you're in your 60s and have just retired, you may have a golden window, often between ages 60 and 72, when your income is lower and you can convert at favorable rates. Every year you delay, the window narrows, and the IRS's grip on your retirement savings tightens. Let's recap the pitfalls. So far, we've covered 5 of the most common and expensive mistakes retirees make with Roth conversions: pushing into higher tax brackets, triggering Medicare surcharges, paying taxes from the IRA, increasing Social Security taxation, and missing the optimal conversion window. Each of these mistakes can cost you anywhere from a few thousand to tens of thousands of dollars over your retirement. The most successful retirees I've worked with avoid these traps by planning carefully, projecting the tax impact in advance, and coordinating every piece of their financial puzzle. They never rush, never guess, and always seek advice from seasoned professionals. This is educational content, not personalized financial advice. Always consult a qualified financial advisor and a tax professional before making any Roth conversion decisions. A conservative, safety-first approach is the best way to protect your principal and maximize your lifetime after-tax income. Now, once you avoid these traps, you can access advanced strategies that most people never learn. Techniques that can further optimize your tax situation, increase your retirement income, and protect your legacy for the next generation. That's just the beginning. Here's where it gets really powerful. Part 5. Advanced Roth conversion strategies the wealthy quietly use. Now that you know how to avoid the most common and expensive mistakes with Roth conversions, let's move into the territory where truly savvy retirees thrive. In my 30-plus years guiding affluent Americans through the complexities of retirement finance, I've seen the most successful seniors consistently leverage a few advanced strategies, techniques that go far beyond the basics and can unlock tens or even hundreds of thousands of dollars in additional tax savings over the course of retirement. These are the methods that industry insiders use, and they're available to you if you plan carefully, work with a qualified advisor, and stay focused on long-term results. Remember, this is educational content, not personalized financial advice. You should always consult with a qualified financial advisor who understands your specific situation before implementing any advanced techniques. Now, let's explore 3 sophisticated Roth conversion strategies that can help you optimize your retirement, minimize taxes, and maximize the wealth you pass on to your loved ones. Strategy 1. Partial Roth conversions paired with bracket management. This is one of the most powerful yet underutilized strategies for retirees who want to systematically reduce their future tax burden. The idea is simple in concept but requires careful annual planning. Instead of converting a large lump sum, you convert just enough each year to fill up your current tax bracket, often the 12% or 22% bracket, without spilling into the next higher bracket. This approach lets you spread your tax liability over multiple years, ensuring you never pay more than necessary in any single year. For example, let's say you're a married couple, age 65, with $80,000 in taxable income. The top of the 22% bracket for 2024 is $201,050. That means you could potentially convert up to $121,050 from your traditional IRA to your Roth IRA this year, and still pay no more than 22% on the converted amount. If you're a single filer, the top of the 22% bracket is $100,525, so your annual conversion cap would be lower. By repeating this process each year between retirement and age 73, when RMDs start, you can move a substantial portion of your savings to tax-free status at the lowest possible rates. The beauty of this strategy is that it gives you complete control over the pace and tax impact of your conversions. It also helps you avoid the Medicare IRMA surcharges and Social Security tax traps we discussed earlier, because you can fine-tune the conversion amount each year to stay below critical income thresholds. Strategy 2. Roth conversion clustering in low-income years. Another advanced approach is to take advantage of unusually low-income years, such as the period after you retire, but before you start Social Security or pension benefits, to execute larger Roth conversions at a temporarily reduced tax rate. This is sometimes called conversion clustering, and it's a favorite among retirees who have flexibility in when they draw income. Suppose you retire at 62 and decide to delay both Social Security and pension income until age 70. For those 8 years, your taxable income may be quite low, perhaps just enough to cover living expenses from cash savings or a taxable brokerage account. This creates a unique window where you can convert $50,000, $75,000, or even $100,000 per year from your IRA to your Roth and pay taxes at the 12% or 22% rate, rather than the 24% or 32% rate you might face once RMDs and Social Security kick in. I've seen retirees use this strategy to convert $400,000 to $600,000 over a 5 to 8 year window, paying as little as $60,000 to $120,000 in total taxes, while avoiding much higher taxes in later years. If you anticipate a few low-income years, coordinate your withdrawals and conversions to take full advantage of this period. The key is to work closely with a tax professional to model your projected income and conversion amounts year by year. Strategy 3. Backdoor Roth and Mega Backdoor Roth contributions. This technique is especially relevant for those who still have earned income or access to an employer plan, even after age 60. The backdoor Roth is a way to contribute to a Roth IRA even if your income exceeds the regular contribution limits. Here's how it works. You make a non-deductible contribution to a traditional IRA, then convert that amount to a Roth IRA. Since you've already paid taxes on the contribution, the conversion is either tax-free or has minimal tax impact. For retirees still working part-time or consulting, or for those whose spouses have earned income, this can be a way to continue building tax-free savings even in retirement. The Mega Backdoor Roth is a similar concept, but it uses after-tax contributions to a 401k plan, which can then be rolled over to a Roth IRA or Roth 401k. Some plans allow up to $66,000 in after-tax contributions for 2024, creating a powerful tax-free growth engine for those with substantial savings capacity. While these techniques are more complex, they can add $20,000, $40,000, or even $100,000 or more to your tax-free retirement pool over time. The warning here is that the rules are intricate, so you must work with a professional to avoid pitfalls like the pro rata rule, excess contribution penalties, or plan restrictions. Bonus optimization, charitable giving with qualified charitable distributions, QCDs. For retirees who are charitably inclined, combining Roth conversions with qualified charitable distributions, QCDs, can be a tax-efficient way to support your favorite causes while managing your taxable income. Once you reach age 70 and a half, you can direct up to $100,000 per year from your IRA directly to a qualified charity. QCDs count towards your RMDs but are not included in your taxable income. This can help offset the tax impact of prior Roth conversions and keep your Medicare and Social Security taxation under control. For example, I worked with a client who converted $250,000 to a Roth IRA over several years, then used QCDs to satisfy her RMDs in later years, effectively reducing her taxable income by $20,000 per year while supporting her church and local hospital. This approach can save $5,000 to $10,000 per year in taxes, depending on your situation. Tax implications. The bottom line. Each of these advanced strategies carries its own tax implications, and the benefits can be substantial. By carefully managing your conversions, taking advantage of low-income years, and leveraging backdoor Roth contributions, or QCDs, you can keep tens of thousands of dollars out of the IRS's hands and in your family's pocket. The most successful retirees I advise are those who revisit their conversion strategy every year, adjust for changes in tax law, and coordinate with other elements of their financial plan, like Social Security, Medicare, and estate planning. Let me repeat this for emphasis. The key to maximizing your Roth conversion benefits is not just doing a conversion, but doing it at the right time, in the right amount, and with an eye toward your entire financial picture. That's how the wealthiest and most financially secure retirees I've worked with have achieved such remarkable results. This is educational content, not personalized financial advice. Consult with a qualified financial advisor and tax professional to tailor these strategies to your unique situation. A conservative, safety-first approach will help you avoid costly missteps and ensure your retirement plan stands the test of time. The key to success is getting your timing exactly right, because even the best strategy can fall flat if you miss the optimal window. In the next section, I'll break down the step-by-step timeline and sequence to follow, so you know exactly what to do first, second, and third. But timing is crucial. Here's exactly when to act to capture the greatest benefit. Part 6. The Roth Conversion Timeline. Your 90-day roadmap to tax-free retirement income. By now, you've seen how powerful Roth conversions can be when executed with care and precision. You've learned the most common mistakes to avoid and discovered advanced strategies that wealthy retirees use to build and protect their legacies. But here's where even the most motivated seniors can stumble. Without a clear timeline and a step-by-step sequence, it's easy to get overwhelmed or miss critical deadlines. In my 30-plus years of guiding retirees through this process, I've found that a structured 90-day roadmap not only builds confidence, but also dramatically increases your chances of success. Remember, this is educational content, not personalized financial advice. Always consult a qualified financial advisor and tax professional before making any moves. Let's walk through a practical, conservative, and actionable timeline you can follow to implement your Roth conversion strategy. No guesswork, no surprises, just a clear path forward. Day 1 to 30. Preparation and discovery. The first month is all about gathering information, clarifying your goals, and laying the groundwork for smart decision-making. The most successful retirees I've worked with never rush this stage. Instead, they take the time to get organized and bring their advisory team into the loop. Start by collecting all your relevant financial documents, IRA, 401k, and brokerage account statements, recent tax returns, and Social Security benefit statements. If you're married, gather your spouse's information as well. Make sure you have up-to-date balances for each account and know your current sources of income, including pensions, annuities, rental income, and any required minimum distributions if you're already over age 73. Next, schedule a meeting with your financial advisor and tax professional. Let them know you're considering a Roth conversion and want a comprehensive analysis. In my experience, the most successful retirees are those who involve both their investment and tax advisors from the very beginning. Your professionals can help you project your taxable income for the year, estimate your federal and state tax brackets, and identify any potential pitfalls like Medicare IRMA thresholds or Social Security tax traps. During this first 30 days, clarify your goals. Are you focused on reducing future RMDs, minimizing taxes for your heirs, or keeping your Medicare premiums low? Prioritize what matters most to you and your family. This clarity will guide every decision you make in the coming weeks. Days 31 to 60. Analysis, modeling, and decision-making. With your documents in hand and your team assembled, the next 30 days are about running the numbers and making informed choices. Ask your advisor to model several scenarios. What happens if you convert $30,000 this year? What about $60,000? How would that impact your current tax bill, your future RMDs, and your Medicare premiums? A good advisor will use specialized tax planning software to show you the impact of different conversion amounts year by year. They'll help you identify your conversion cap, the maximum you can convert without crossing into the next higher tax bracket or triggering IRMA surcharges. For example, if you're a married couple with $110,000 in taxable income, you could convert up to $91,050 and stay in the 22% federal bracket for 2024. But if you're close to the $206,000 IRMA threshold, you may want to keep your total income just below that line. This is also the time to decide how you'll pay the taxes on your conversion. The most successful retirees set aside cash from a savings or brokerage account, never from the IRA itself. If you need to raise cash, talk to your advisor about the best assets to sell, keeping in mind any capital gains taxes. Once you've reviewed the scenarios and weighed your goals, it's time to make your decision. Decide on the exact amount to convert this year and set a target date for the conversion, ideally later in the year, when you have the clearest picture of your total income. Days 61 to 75. Execution and confirmation. Now you're ready to take action. Contact your IRA or 401k custodian, such as Fidelity, Vanguard, Schwab, or your bank, and request the Roth conversion paperwork. Most custodians allow you to initiate the conversion online or over the phone, but some may require signed forms. Specify the exact dollar amount you want to convert and double-check that your beneficiary designations are up to date. If you're converting investments in kind, moving shares rather than selling and transferring cash, confirm with your advisor that the assets are eligible for Roth status and that there are no restrictions or penalties. If you're converting cash, make sure the funds are available in your IRA before starting the process. Once the conversion is complete, you'll receive a confirmation statement from your custodian. Keep this for your records, as you'll need it for tax reporting. Let your tax professional know the exact amount converted so they can plan for the additional income on your return. Days 76 to 90. Tax planning and final review. With the conversion complete, it's time for a final review to ensure everything is in order. Meet with your tax professional to estimate your total tax liability for the year, including the Roth conversion. If you need to make estimated tax payments to avoid underpayment penalties, do so before the quarterly deadline, typically January 15th for the previous tax year. Review your Social Security income and Medicare premiums for the following year and confirm that your conversion hasn't pushed you over any critical thresholds. If you're close, your advisor may recommend additional strategies, such as charitable giving through qualified charitable distributions, to offset the impact. Finally, update your financial plan and beneficiary designations to reflect the new Roth IRA balances. Consider how your conversion fits into your broader estate plan. The most successful retirees revisit their Roth conversion strategy every year, adjusting the amount and timing as their income, expenses, and tax laws change. Important deadlines and dates to remember. December 31st. Roth conversions must be completed by this date to count for the current tax year. Don't wait until the last minute, as custodians may have earlier internal deadlines, often December 15th to 20th. January 15th. Deadline for fourth quarter estimated tax payments for the previous year. October 15th. If you file for a tax extension, this is your final deadline to submit your return. but your Roth conversion must still be completed by December 31st of the previous year. A recap of your 90-day timeline. So far, we've covered a clear step-by-step process. Gather your documents and team, days 1 through 30. Model your scenarios and decide on your conversion amount, days 31 through 60. Execute the conversion and confirm the details, days 61 through 75, and complete your tax planning and final review, days 76 through 90. This conservative, methodical approach is the secret weapon that the most successful retirees use to maximize benefits and minimize stress. But even with the best plan, you might encounter roadblocks along the way, unexpected tax issues, paperwork delays, or changes in your income. The key is not to panic, but to know exactly how to troubleshoot and adapt. Even if you follow this perfectly, you might encounter these common roadblocks. Part 7. Troubleshooting. Your Roth conversion. Overcoming roadblocks with confidence. You've mapped out your Roth conversion plan, worked through the numbers, and set a clear timeline. But as with any major financial decision, the road from strategy to execution can have a few bumps along the way. In my 30-plus years of guiding retirees through Roth conversions, I've seen nearly every challenge you can imagine, and I can assure you there's almost always a conservative, safety-first solution that protects your principal and keeps you on track. Remember, this is educational content, not personalized financial advice. Always consult with a qualified financial advisor for your unique circumstances. Let's walk through some of the most common implementation challenges and how to address them so you can move forward with clarity and peace of mind. Challenge 1. My income changed mid-year. Will I blow up my tax bracket? This scenario is more common than you might think. Maybe you took on some consulting work, sold an investment property, or your spouse decided to work part-time. Suddenly, your taxable income is higher than you anticipated, and you're worried that your planned Roth conversion will push you into a higher tax bracket or trigger Medicare RMDs surcharges. Here's what you can do. First, don't panic. The most successful retirees I've worked with always build in a margin of safety. If your income changes mid-year, revisit your tax projection with your advisor or CPA as soon as possible. If you haven't executed your conversion yet, you may decide to reduce the amount or postpone part of it to next year. Remember, you have until December 31st to complete your conversion for the current tax year, so if your income rises unexpectedly in August or September, you can still adjust your plans before year-end. If you've already completed a partial conversion and discover your income is too high, you can avoid going over critical thresholds by stopping additional conversions for the year. The key is to monitor your total income regularly and stay in close communication with your advisory team. Challenge 2. The paperwork is delayed or the custodian made an error. What now? Even with the best preparation, administrative hiccups can happen. Maybe your IRA custodian is slow to process the conversion, or there's a clerical error that causes a delay. I've seen retirees get anxious when a conversion initiated in December doesn't show up as completed until January, potentially pushing it into the next tax year. Here's the conservative approach. Always initiate your Roth conversion well before the December 31st deadline. I advise my clients to start the paperwork by early December at the latest, ideally by December 1st. If your custodian makes an error, contact them immediately and keep a written record of all communications. Most reputable firms like Fidelity, Vanguard, Schwab, and others have processes to correct administrative mistakes, especially if you can show you initiated the transaction on time. If the conversion does get processed in the wrong year, your tax professional can help you document the issue, and in some cases, petition the custodian or IRS for a correction. However, it's much safer to plan ahead and avoid last-minute conversions. Challenge 3. I don't have enough cash on hand to pay the taxes. Should I still convert? This is a question I hear regularly from retirees who are asset-rich but cash-light. As we discussed earlier, paying the tax bill from outside your IRA is the safest and most effective way to maximize your Roth's long-term growth. But what if most of your assets are tied up in retirement accounts or investments? Here's what many successful retirees do. Consider a smaller, partial conversion that fits within your available cash. For example, if you have $10,000 in savings earmarked for taxes, you might convert $40,000 this year rather than $100,000. Alternatively, review your taxable brokerage accounts for highly appreciated positions you could sell at favorable capital gains rates to raise the cash needed. Be sure to coordinate any sales with your advisor to avoid triggering large capital gains or pushing yourself into a higher bracket. If paying taxes from your IRA is the only option, proceed with caution. Withholding taxes from the conversion itself reduces the amount that gets into your Roth, and if you're under age 59 and a half, could trigger a 10% penalty on the withheld amount. Most retirees over 60 avoid this penalty, but the lost compounding can still cost you tens of thousands over time. A conservative approach is to wait until you have the cash on hand before executing a large conversion. Challenge 4. What if the market drops after I convert? A common worry, especially for risk-averse retirees, is what happens if you convert $50,000 to a Roth IRA and the market falls 20% soon after. You've just paid taxes on $50,000, but now your Roth is only worth $40,000. In the past, you could recharacterize or undo a conversion, but that option was eliminated in 2018. So what's the best approach? Industry insiders use a technique called conversion staging. Rather than converting your full target amount at once, you can spread conversions throughout the year or over several years. For example, you might convert $20,000 in March, $20,000 in June, and $20,000 in November. If the market drops after your first conversion, you can pause and wait for a recovery before proceeding with additional conversions. Another conservative method is to convert investments that are temporarily undervalued. If you have a stock or mutual fund that has recently dropped in price, but you believe in its long-term prospects, converting it while it's down means you'll pay less in taxes and capture more upside tax-free when it rebounds. What if scenario? I made a mistake. Can I fix it? While the IRS no longer allows recharacterizations of Roth conversions, you still have options if you realize you've made a mistake. If you converted too much and face a large tax bill, talk to your CPA about increasing your withholding or making an estimated tax payment before the January 15th deadline to avoid penalties. If you've triggered an IRMA surcharge, your advisor can help you appeal the premium increase if you've had a qualifying life event, such as retirement, divorce, or the death of a spouse. The most important thing is to stay proactive, keep detailed records, and communicate regularly with your advisory team. The most successful retirees I work with aren't afraid to ask questions, double-check paperwork, or seek a second opinion when something doesn't feel right. Recap and confidence. So far, we've covered how to handle unexpected income changes, paperwork delays, tax payment challenges, and market volatility. The key is to approach every challenge with a calm, methodical mindset, never rushing, never panicking, and always putting your long-term security first. The retirees who thrive are those who treat their Roth conversion as an ongoing process, not a one-time event. This is educational content, not personalized financial advice. Always consult with a qualified financial advisor and tax professional before taking action. A conservative, safety-first approach will help you navigate any roadblocks and keep your retirement plan on track. Once you master this foundation, you're ready for the next level, where you can fine-tune, optimize, and scale your strategy for even greater results. That's just the beginning. Here's where it gets really powerful. Part 8. Next Level Roth Optimization, Scaling, Fine-Tuning, and Protecting Your Legacy. Congratulations on making it this far. If you've followed along through each part of this series, you already know more than most retirees ever will about Roth conversions. You've learned how to sidestep the tax traps, avoid the common mistakes, and build a step-by-step plan for converting your retirement savings into tax-free income. But here's where the most successful, affluent retirees truly separate themselves. They don't stop at the basics. They keep optimizing, scaling, and adjusting their strategies as life changes, tax laws evolve, and new opportunities arise. In my 30-plus years of guiding American seniors through retirement transitions, I've seen that those who revisit and refine their Roth approach every year consistently achieve more financial freedom, lower taxes, and a stronger legacy for their families. Remember, this is educational content, not personalized financial advice. Always consult with a qualified financial advisor and a tax professional before making adjustments to your strategy. Let's explore the next-level actions and advanced optimization techniques that can help you maximize every dollar you've worked so hard to save. Annual Roth Conversion Reviews. Stay ahead of the curve. The most successful retirees I work with treat their Roth conversion plan as a living, breathing part of their financial life. Each year, usually in the fall, they sit down with their advisory team to review their income, tax brackets, investment performance, and anticipated expenses for the coming year. This annual Roth checkup allows you to adjust your conversion amount based on the latest tax brackets, any changes in Social Security or Medicare premiums, and your evolving lifestyle needs. For example, if you had planned to convert $50,000 this year, but an unexpected medical expense reduced your taxable income, you might increase your conversion to fill up the 22% tax bracket. Conversely, if you sold a property and realized a large capital gain, you might reduce or skip your conversion for the year to avoid unnecessary taxes. This flexibility is your greatest asset. Never lock yourself into a rigid, multi-year plan without room to adapt. Scaling up with multi-generational Roth planning. Once your own Roth conversion plan is on track, consider how you can extend these benefits to your loved ones. Many retirees I advise take advantage of family Roth planning, helping adult children or even grandchildren start their own Roth IRAs. If your children have earned income, you can gift them up to $7,000 per year, the 2024 Roth IRA contribution limit for those age 50 and older, to jumpstart their tax-free savings. Over 30 years, even a modest annual contribution can grow to $500,000 or more, completely tax-free. For those with significant wealth, consider funding Roth IRAs for multiple generations as part of your estate plan. When you pass, your heirs can inherit Roth IRAs and enjoy tax-free withdrawals over a 10-year period thanks to the Secure Act. This strategy can multiply the tax-free benefits of your conversions across your entire family tree. In my experience, the wealthiest retirees use this approach to create a legacy that lasts far beyond their own lifetimes. Tax loss harvesting and Roth conversion pairing. Here's an insider technique that many affluent retirees use: pairing Roth conversions with tax loss harvesting in their taxable investment accounts. If you have investments in a brokerage account that have lost value, you can sell those positions to realize a capital loss, which can offset up to $3,000 in ordinary income per year, or more if you have capital gains. By harvesting losses in the same year, you do a Roth conversion. You can effectively reduce the tax impact of your conversion, sometimes saving $1,000, $2,000, or more in taxes for the year. For example, I worked with a retiree who converted $80,000 to a Roth IRA in a year when the market was down. By harvesting $15,000 in capital losses from his taxable account, he lowered his overall tax bill by nearly $3,500. This approach is especially powerful during periods of market volatility, when losses are more common and Roth conversions are even more attractive. Coordinating Roth conversions with charitable giving. If charitable giving is part of your retirement plan, you can combine Roth conversions with qualified charitable distributions, QCDs, to maximize your tax efficiency. Once you reach age 70 and a half, you can direct up to $100,000 per year from your IRA directly to qualified charities, satisfying your RMDs and reducing your taxable income. By planning your Roth conversions in years when you also make large qualified charitable distributions, you can keep your income below critical tax and Medicare thresholds while supporting the causes you care about. I've seen retirees use this strategy to save $5,000, $10,000, or more in taxes each year, all while making a significant impact in their communities. The key is careful coordination with your advisor to ensure the timing and amounts are optimized for your unique situation. Long-term considerations. Stay flexible as laws and life change. One thing I've learned over 3 decades is that tax laws, markets, and life circumstances are always changing. The retirees who do best are those who stay informed and flexible. Keep an eye on proposed tax law changes, such as increases to ordinary income or capital gains rates, changes to RMD rules, or adjustments to Roth IRA contribution limits. If Congress raises tax rates, the value of your Roth conversions could increase dramatically. If laws change in ways that affect your strategy, don't hesitate to revisit your plan with your advisory team. Also, consider your own evolving needs. As you age, your spending patterns may change, healthcare expenses may increase, or your family situation may shift. Review your withdrawal strategy annually to ensure you're drawing from the right accounts at the right time, balancing tax efficiency, income needs, and legacy goals. Estate planning, protecting your Roth legacy. Don't overlook the estate planning aspects of your Roth strategy. Make sure your beneficiary designations are up to date and discuss with your advisor how your Roth IRA will pass to your heirs. Under current law, non-spouse beneficiaries must withdraw inherited Roth IRA funds within 10 years, but those withdrawals remain tax-free. Consider whether a trust is appropriate for your situation, especially if you have concerns about how heirs will manage their inheritance. For high net worth families, advanced estate planning tools, such as Roth conversion ladders combined with charitable trusts or gifting strategies, can help you maximize the impact of your wealth for generations to come. In my experience, the happiest retirees are those who know their legacy is protected and their loved ones are set up for long-term financial security. A final recap: your path to Roth mastery. Let's quickly review what we've covered in this next level section. Annual reviews, family Roth planning, tax loss harvesting, charitable coordination, staying flexible with changing laws, and integrating your Roth strategy into your estate plan. All of these are powerful ways to scale and optimize your Roth conversions for maximum benefit. The most successful retirees I've advised are those who treat their financial plan as a living document, revisiting and refining it every year. This is educational content, not personalized financial advice. Always consult a qualified financial advisor and tax professional before making any significant financial moves. A conservative, safety-first approach, paired with regular reviews and smart adjustments, is the best way to ensure your Roth conversion strategy delivers lasting results. Now that you've mastered the foundation and advanced techniques, you're ready to put it all together for a retirement that's truly tax-smart, secure, and flexible. In our final conclusion, I'll show you how to bring all these elements together for a retirement plan that stands the test of time, because what I'm about to share will surprise even experienced investors. Over the past hour, we've covered a tremendous amount of ground together, far more than most retirees will ever encounter in a single educational session. We started by identifying the hidden tax traps embedded in traditional retirement accounts, from escalating RMDs to unexpected Medicare surcharges and the risk of future tax hikes. We explored the core solution, strategic Roth conversions, and why this approach is especially effective for affluent seniors. We walked through practical implementation steps, highlighted costly mistakes to avoid, and revealed advanced optimization strategies that the most financially secure retirees consistently use. We mapped out a detailed 90-day timeline, tackled common roadblocks, and finally, we looked at next-level actions like family Roth planning and integrating charitable giving. The knowledge you've gained today could easily save you tens or even hundreds of thousands of dollars over your lifetime. This isn't entertainment, it's valuable financial education distilled from decades of real-world experience helping retirees just like you optimize for security, legacy, and peace of mind. In my decades of helping retirees navigate these waters, I can tell you what separates those who thrive from those who struggle is almost always knowledge and implementation. Now that you understand each piece, let me show you how they work together in a truly powerful, integrated retirement strategy. When you approach Roth conversions with a clear plan, timing them during your low-income years, filling up the right tax brackets, coordinating with your Social Security and Medicare, and reviewing annually, you create a compounding effect that goes far beyond the sum of its parts. A retiree who strategically converts $50,000 per year for 5 years, for example, could reduce lifetime taxes by $75,000, avoid $15,000 in Medicare surcharges, and leave an additional $100,000 or more to heirs, all tax-free. That's not theory. It's the real-world result I've seen again and again. This is why wealthy retirees with even modest starting balances often outperform peers who simply let it ride in tax-deferred accounts. The most successful clients I've worked with consistently apply these principles, adjusting each year as their life evolves. Let me emphasize this important point. When you layer these strategies, annual reviews, family Roth planning, tax loss harvesting, and charitable coordination, you don't just save on taxes. You gain flexibility, control, and the peace of mind that comes from knowing your plan is built to last. So, what should you do next? Here are 4 specific steps you can take in the next 30 days to start transforming your retirement finances. Step 1. Assessment phase, first week. Start by gathering these 3 essential documents: your most recent IRA 401 KO statements, last year's tax return, and your Social Security benefit estimate. Calculate your current taxable income and project where you'll stand once RMDs begin. Identify your biggest opportunity area. Is it reducing future RMDs, minimizing Medicare surcharges, or maximizing your legacy? This self-assessment will anchor your entire strategy. Step 2. Planning phase, second week. Create your personalized timeline. Are you in the critical window between retirement and age 73? Map out the years you can convert at the lowest rates. Research the specific Roth conversion options that fit your situation, such as partial annual conversions or pairing with tax loss harvesting. Document your current withdrawal strategy and compare it to what you've learned here. Where are the gaps? Step 3. Professional consultation, third week. Schedule a meeting with a qualified financial advisor and a tax professional. Bring these specific questions. How much can I convert this year without entering a higher tax bracket or triggering IRMA? How will a Roth conversion impact my Social Security and Medicare? Can we model different scenarios for the next 5 years? Verify that your advisor is fluent in advanced Roth strategies. Not all are. If you're charitably inclined, ask about integrating QCDs for maximum efficiency. Step 4. Implementation begins, fourth week. Start with the lowest risk, highest impact change, perhaps a modest partial conversion this year, paid for with outside cash. Set up the Roth IRA if you don't already have one, and initiate the conversion paperwork well before year-end. Begin tracking your progress using 3 simple metrics: your taxable income, projected required minimum distributions, and total Roth balances. Each year, revisit your plan and adjust as needed. The goal is steady, compounding improvement. Let me emphasize this important point. Every financial strategy carries some level of risk, and there's no such thing as a perfect plan. The goal isn't perfection, it's optimization based on your unique situation and goals. Most successful retirees implement these changes gradually, over 6 to 12 months or even several years. Don't let perfectionism or fear of mistakes prevent you from making small, smart improvements. These aren't get-rich-quick schemes. They're proven conservative strategies that have stood the test of time through multiple market cycles and changing tax laws. Remember, this has been educational content designed to inform your decision-making. Every individual's financial situation is unique. What works for one person may not be optimal for another. Always consult with qualified financial and tax professionals before making significant changes. Past performance of any strategy doesn't guarantee future results, and tax implications may change with future legislation. While this information provides a strong foundation, professional guidance is invaluable. Tax professionals and estate planning attorneys can ensure you're maximizing benefits while staying compliant and protecting your legacy. You're now part of a community of informed retirees who refuse to settle for average. The journey to financial optimization is ongoing. Markets change, laws evolve, and your needs will shift over time. Continue your education by staying up to date on retirement planning developments and sharing your experience with others. I encourage you to share your success stories and learn from those who are walking the same path. You'll know you're on the right track when your financial stress decreases, your confidence grows, and you have clear answers to the questions that used to keep you awake at night. The goal is progress, not perfection. Small improvements compound over time, and your family will benefit from the wise decisions you make today. If this video helped clarify your retirement planning strategy, please give it a thumbs up so others can benefit as well. Share your biggest takeaway in the comments below. What surprised you most, and which strategy will you implement first? Have you already started converting to Roth, or are you just beginning your journey? What's your biggest concern about retirement planning that we should address in future content? Subscribe for more in-depth retirement guidance that could save you thousands and help you protect your family's future. Most importantly, take action on what you've learned. Your future self will thank you. Let me leave you with this. After helping thousands of retirees navigate these decisions, I can tell you that the difference between financial stress and financial freedom is rarely about luck or timing. It's about taking informed, strategic action, one step at a time. Imagine the peace of mind that comes from knowing you've optimized every aspect of your retirement finances, protected your legacy, and maintained your independence and dignity. You've worked too hard to settle for less. Take the next step and let your retirement years be the best, most secure, and most rewarding of your life.